Something extraordinary happened yesterday. While financial networks broadcast their usual market commentary and analysts debated quarterly earnings, a seismic shift occurred in one of the world's most critical financial markets. The kind of shift that doesn't generate immediate headlines, but quietly rewrites the rules of global wealth. It's January 21st, 2026. And what unfolded in the Japanese bond market yesterday represents more than just numbers on a screen. It's a fault line cracking open beneath the entire architecture of modern finance. I'm going to walk you through what happened, why it matters to your wealth, and what intelligent investors are doing right now while others remain distracted by surface-level noise. This is the wealth continuum, where we decode the patterns that shape generational wealth. And today's pattern is one you cannot afford to ignore. Let me show you exactly what transpired yesterday in the data. Japanese 30-year government bonds saw yields spike to 3.906%, an explosion of over 8% in a single session. To put that in perspective, sovereign bonds from stable developed nations simply don't move like this. These instruments are designed to be the bedrock of stability, the foundation upon which pension funds, insurance companies, and banks build their entire risk models. The 40-year Japanese bond yield hit 4.22%. This isn't just a new high for the year or the decade. This is uncharted territory in modern financial history. We've never witnessed Japanese yields at these levels, not through the deflationary decades of the 1990s and 2000s, not during any previous crisis. Meanwhile, the 10-year yield climbed to 2.37%, the highest level since the 1990s. For a nation that has spent 3 decades fighting deflation with zero and negative interest rates, this represents a complete regime change. And the tremors didn't stay contained to Tokyo. U.S. Treasury yields responded immediately. The 10-year climbed to 4.30%. The 30-year is now approaching 5%, currently at 4.93%. That psychological barrier matters more than most people realize. But here's where it gets fascinating for those tracking real assets. Gold is trading at $2,159 per ounce. Silver surged to $94.50 yesterday, testing $95 during intraday action. What's really happening beneath these numbers? Drop a comment below with your thoughts, and let's decode this together. The mechanism, most people miss. There's a technical phenomenon driving this chaos that few mainstream commentators understand. It's called a value at risk shock. And once you grasp this mechanism, everything that follows becomes inevitable. Every major financial institution, banks, pension funds, hedge funds, uses VAR models to monitor portfolio risk. These algorithms calculate the maximum potential loss based on historical volatility patterns. When markets are calm, VAR models allow institutions to hold large positions with relatively modest capital reserves. The system works beautifully until it doesn't. When volatility suddenly explodes, when bond yields start moving 8% in a session instead of 8 basis points, the VAR models immediately trigger alerts. They demand that institutions either post massive additional capital or sell positions to return within acceptable risk parameters. Since most institutions don't have unlimited capital sitting idle, they sell immediately, regardless of price, regardless of fundamentals, regardless of long-term outlook. This creates a vicious feedback loop. Selling triggers more volatility triggers more VAR breaches trigger more forced selling. A safety mechanism designed to protect institutions becomes the accelerant for the crisis. Right now, Japanese government bonds are experiencing volatility levels that break these models. Institutions are hitting VAR limits simultaneously, all trying to exit through the same door at the same time. It's not a choice. It's mathematical necessity. And once this cascade begins, it doesn't stop until either central banks intervene with overwhelming force or the market finds a new, much lower equilibrium. The debt arithmetic. Nobody wants to acknowledge. Let me show you the mathematics that make this more than just a temporary disruption. This is where theory collides with brutal arithmetic reality. Japan's national debt stands at approximately 250% of GDP, roughly 10 trillion in total obligations. If the average yield on that debt rises to 4%, which is where we are right now, the annual interest expense becomes $400 billion. Japan's total tax revenue in a typical year, around $550 billion. Do that calculation. Interest expense alone would consume nearly 73% of all tax revenue. That leaves $150 billion for everything else. Defense, healthcare, pensions, infrastructure, government operations, everything. The equation doesn't balance, but it gets worse. Prime Minister Takahashi just promised significant tax cuts to win the February elections. Those cuts would reduce government revenue by an estimated $50 to $70 billion annually. Now you're looking at interest expenses consuming close to 90% of tax revenue. And we haven't even factored in the rolling over of existing debt. Japan must constantly refinance maturing bonds. If the market refuses to buy new issuance at 4% yields, which is exactly what we saw in the recently failed 20-year auction. Where does the funding come from? The Bank of Japan could print yen and purchase bonds directly, but that option leads to an equally catastrophic outcome, which we'll explore in a moment. The mathematics here aren't political opinion, they're arithmetic, and arithmetic is final. What do you think Japan does next? Share your perspective in the comments. You've likely heard the standard counterarguments by now. The Bank of Japan will just print money and buy bonds like they always do. They have unlimited yen. This is a non-issue. That argument sounds reasonable until you think through the second-order consequences. Yes, the Bank of Japan can theoretically create unlimited yen, but we're not operating in the 2010s anymore. The global context has fundamentally changed. If the Bank of Japan announces unlimited quantitative easing right now, if they start printing yen to purchase their own bonds in massive quantities, what happens to the yen exchange rate? It collapses. Immediately and dramatically. Japan imports virtually all of its energy, much of its food, and critical raw materials. If the yen hyperinflates, the cost of those imports skyrockets overnight. You get imported inflation, a cost of living crisis, and political instability that makes the current situation look manageable. Japan faces an impossible choice: let bond yields explode and face debt insolvency, or print money to suppress yields and face currency collapse and hyperinflation. There is no just print money solution that doesn't create an equally devastating problem. That's the doom loop. That's why this time is different from previous interventions. The silver signal. While chaos unfolds in bond markets, something remarkable is happening in precious metals. Silver is outperforming gold on a percentage basis. This tells us something critical about investor psychology. Gold is the traditional safe haven, the asset you buy when you're worried about general uncertainty. Silver, historically, is what investors buy when they're betting on systemic monetary chaos. The silver-to-gold ratio is shifting dramatically. Investors aren't just seeking safety. They're positioning for a fundamental repricing of monetary assets. And here's the overlooked dimension. Silver has massive industrial demand. It's essential for solar panels, electronics, electric vehicles, medical applications. Industrial demand for silver is growing, not shrinking. Meanwhile, mining production has been relatively flat for years. You have rising industrial demand, constrained supply, and now a surge in investment demand as capital flees sovereign debt. The physical market is tight. Dealers are reporting delivery delays. Premiums for physical coins and bars are widening over spot prices. The COMEX silver inventories are low relative to open interest in futures contracts. If a significant number of futures holders demand physical delivery instead of rolling contracts or settling in cash, the exchange doesn't have enough physical metal to fulfill those requests. That's the setup for a short squeeze. That's why $100 isn't the ceiling. It's the beginning of a repricing. This pattern isn't unprecedented. We've seen this before. In the late 1970s, the United States dealt with stagflation, oil shocks, and a crisis of confidence in the dollar after Nixon ended the gold standard. Inflation raged, bond yields spiked, and investors lost faith in the government's ability to manage the economy. What happened to silver? It went from around $4 per ounce in 1979 to over $50 per ounce in 1980. More than a tenfold increase in roughly 1 year. I'm not forecasting a tenfold move from current levels, but the pattern instructs us. When confidence in sovereign debt collapses, when inflation expectations become unanchored, when people realize governments cannot pay debts without destroying currencies, they flee into hard assets. Silver, being more affordable than gold on a per-ounce basis, becomes the vehicle for middle-class wealth preservation. There's also a psychological element worth noting. When people see silver at $94, a narrative forms. I missed gold at $1,000. That narrative drives buying pressure. And once silver crosses $100, the momentum becomes self-reinforcing. The psychological barrier breaking shifts the narrative from, it's too expensive, to, I need to buy before it goes higher. Have you positioned any of your wealth in physical assets? What's holding you back? Let's discuss in the comments below what the Wealth Continuum is watching today. As we move through today and into the rest of this week, here are the specific indicators I'm monitoring for the Wealth Continuum community. First, the 4.0% threshold on Japanese 30-year yields. If it crosses 4 and remains above 4 for multiple sessions, that confirms the debt trap has closed. Japan runs out of viable options. Second, the US 30-year Treasury hitting 5.0%. That's a psychological level that triggers institutional algorithm-driven selling. Once the 30-year crosses 5, the narrative shifts from bond volatility to bond crisis. Third, silver breaking $100 per ounce on spot price. That level makes short squeeze dynamics unavoidable. Massive short positions from bullion banks that have suppressed prices for years will be forced to cover. If these three triggers hit simultaneously, Japanese 30-year above 4, US 30-year above 5, silver above $100, the orderly exit from sovereign debt becomes a route. At that point, we're looking at a wholesale repricing of risk across the entire global financial system. Fourth, today's Japanese bond market action. How does the market respond after yesterday's chaos? Do yields stabilize or continue climbing? Any statements from the Bank of Japan will be critical. Fifth, geopolitical developments. President Trump was just inaugurated yesterday. Trade tensions, tariff announcements, policy shifts. These are catalysts that could accelerate the timeline. Let me zoom out and put this in the largest possible context. We are potentially witnessing the end of a 40-year debt supercycle that began when Paul Volcker broke the back of inflation in the early 1980s. Since then, interest rates have been in structural decline. Governments and corporations have accumulated more and more debt, confident that rates would stay low and refinancing would remain easy. The entire global economy has been constructed on the assumption of cheap credit. Asset prices, stocks, bonds, real estate, have been inflated by decades of falling rates and expanding money supply. But that cycle is ending. Rates can't go lower. Central banks tried negative rates in Japan and Europe, and it created zombie companies and misallocated capital without solving structural problems. Now rates are rising. And in a world with record debt levels, rising rates represent an existential threat. Japan is the canary in the coal mine. Their debt to GDP ratio is the highest in the developed world. If they can't manage rising rates with their level of discipline and institutional strength, who can? When Japan's bond market breaks, contagion spreads because the global financial system is interconnected. Japanese banks own European bonds. European banks own U.S. bonds. U.S. pension funds own Japanese bonds. It's an intricate web of cross-holdings and leverage. When one thread breaks, the entire web begins to unravel. Here's why this matters to you personally, regardless of whether you actively trade or invest. Your purchasing power is being eroded right now. Whether you're paying attention or not, the value of your savings is being diminished by these exact dynamics. If you have money in a savings account earning 4 to 5% interest, but inflation is running at 6 to 8%, and real inflation is likely higher than official figures, you're losing purchasing power every year. If you have retirement accounts in bonds, you're watching the value of those bonds crater as yields rise. That's not a temporary dip. That's permanent wealth destruction. If you're holding cash, waiting for a buying opportunity, you're watching that cash lose value daily as currency is debased. The system is designed to punish savers and reward asset holders. It's designed to transfer wealth from people holding cash and bonds to people who own hard assets and equity. Most people don't understand this. They think their savings account is safe because it's FDIC insured. But FDIC insurance protects against bank failure, not currency debasement. You'll get your dollars back, but those dollars will buy less than when you deposited them. This is why sophisticated wealth builders maintain positions in hard assets. Not to get rich, but to preserve purchasing power already earned. If you've worked for years and accumulated savings, protecting that wealth from currency debasement becomes essential. What percentage of your portfolio is in assets that can't be printed? Comment below. I read every single one. We've covered substantial ground. Let me synthesize the core thesis. We are observing the early stages of a potential G7 currency crisis. The Japanese bond market reached a critical threshold yesterday. Yields are at historic levels. Auctions are failing. The VAR shock mechanism is forcing institutions into mechanical selling. Japan is trapped between debt insolvency and currency hyperinflation. There is no good option remaining. Either they allow yields to rise and face bankruptcy, or they print money and destroy the yen. Both paths lead to capital flight from sovereign debt. The contagion is spreading to the U.S. Treasury market. As Japan potentially sells treasuries to fund their crisis, U.S. yields are rising in response. The U.S. 30-year approaching 5% would trigger cascading selling. Silver is serving as a release valve. As investors flee bonds, they're accumulating hard assets. Silver outperforming gold signals the market is betting on monetary chaos, not merely seeking safe haven. Central banks will intervene, they must, but their credibility is eroding. Every intervention at this point represents currency debasement, and markets are beginning to recognize that the debt can never be repaid through conventional means. The endgame is a repricing of all assets in terms of hard money. Bonds and cash lose value. Commodities and precious metals gain value. It's a wealth transfer from paper claims to physical assets. And we're watching this unfold in real time today. I don't deliver this analysis lightly. I wish I could tell you that everything is stable, that your savings are secure in bonds and cash, that yesterday's events were just temporary volatility. But the mathematics are final. The yields are telling the truth. And if you understand how to read them, they're communicating clearly that the debt-based fiat system is reaching a critical juncture. You have a choice. You can ignore this information. You can hope central banks will engineer another solution. You can trust that your traditional portfolio will be fine. Or you can take measured action to protect your purchasing power before the window closes. I'm not suggesting panic. I'm advocating preparation. Understanding these mechanisms allows you to navigate the volatility with clarity rather than fear. When the crisis accelerates, when the Japanese 30-year crosses 4, when the US 30-year crosses 5, when silver breaks $100, positioning becomes exponentially more difficult. Premiums on physical metals explode. Dealers run out of inventory. You're chasing prices instead of building positions methodically. The intelligent move is positioning while most people remain distracted. While media still frames this as volatility rather than structural change. The bond vigilantes have returned, the debt trap is closing, and silver is signaling exactly where this is headed. This is the Wealth Continuum. Subscribe if you want to stay ahead of these patterns. Hit the notification bell so you don't miss the next critical analysis as this situation develops. And drop a comment below. What's your biggest takeaway from today's breakdown? Are you watching the bond markets today? I want to hear your perspective. The mathematics don't care about opinions. They don't negotiate. They simply are. Your wealth continuum depends on understanding what they're telling us right now. Trust the math, question the narrative, protect your purchasing power. Until next time, this is the Wealth Continuum, where we decode the patterns that shape generational wealth.